In this video, I want to talk about GARP, GARP. That is growth at a reasonable price. How to find growth stocks without overpaying. Usually, growth stocks are relatively expensive. So, how can you locate a growth stock without having to pay, the high price, they usually attract? So growth at a reasonable price, GAP, is an instrument or is an investment strategy that that seeks to combine the best part of both growth investing and value investing. You want to benefit from growth, and at the same time, you want to equally benefit from value. That is the reason why you need to consider GAP. So investors using the GAP approach looks for companies that show solid growth potentials but are not overvalued. Growth in one hand and value in the other hand. The goal is to find stocks that offer a balanced blend of growth and value, providing the potential for both capital appreciation and downside protection. If you buy a value stock, a stock that displays value characteristics, your downside is protected. If the stocks equally have growth potentials, your upside is guaranteed. What a wonderful benefits. So the key concepts here are: number one, growth investing. So GAP investors seek companies with strong earnings and growth potentials. So these are often companies, in expanding industries or those with innovative products or services. Unlike pure growth investors who might pay any price for high growth, GAP investors are more selective. They look for growth that is available at a reasonable valuation. They want to participate in the potentials of growth. They equally don't want to spend too much. Number two is value investing. So GAP incorporates principle of value investing by focusing on companies that are undervalued or fairly valued relative to their growth prospects. So GAP investors avoid overpaying for growth by considering valuation metrics. They identify a growth company, but they don't want to overpay for that growth. So if they can get it cheap, good and fine. Number three is valuation metrics. So GAP investors often use a combination of growth metrics and valuation ratios to assess potential investments. So common metrics in this regards include price to earning growth ratio. Price to earning growth ratio. We call it PEG ratio. So a key metrics in GAP is the PEG ratio adjusted. The PEG ratio adjusts the price, to earnings ratio by factoring in the company's expected growth rate. You consider PE ratio and at the same time factor in, the expected or the potential growth rates of the company you want to invest in. A PEG ratio of 1 is 1 or lower than 1. Is often considered favorable, indicating that the stock's price is reasonable, relative to its growth prospects. So if you carry out your calculation and you discover that the answer is 1, then that stock is a very good candidate based on this yardstick. Number 2 is the second one is PE ratio. The price to earning ratio is used to gauge whether a stock is overvalued or undervalued relative to its earnings and also relative to other companies in the same sector. That's apple to apple comparison. It's very important. The next one is earnings growth rates. So GAP investors look for companies with consistent and sustainable earning growth, typically in the range of 10 to 20% every year. All right, that is every year, year in, year out, a company should be able to generate a growth of between 10 to 20%. That's a key factor GAP investors do consider. Number four is a balanced approach. Balanced approach. In this context, gap investing is about finding a middle ground. The strategy avoids the extremes of paying high prices for rapid growth, that's pure growth investing, and focusing only on low price stocks, that's pure value investing. Instead, gap investors seek companies that offer steady, sustainable growth at a price that isn't too high. Wow, this strategy is worth considering actually. So let's look at the strategy in practice. So in this context, you have number one, stock selection. When it comes to stock selection, GAP investors focus on companies with strong fundamentals, including solid revenue and earning growth, high return on equity, and a strong cash flow. Strong revenue or sales or earnings growth, as well as some higher return on equity, and also you consider the cash flow. They prefer companies with a competitive edge or mode in their industry. Number two is sector and industry focus. Sector and industry focus. So GAP investors may target sectors with strong growth potential, such as technology, healthcare, and consumer discretionary, but they do so selectively, ensuring that valuations are not overstretched. Number three is risk management. By focusing on reasonable valuation, GAP investing aims to reduce the risk of overpaying for a growth stock, which can be prone to significant price correction if growth expectation does not materialize. If you buy a growth company and the growth potential is not realized, it doesn't materialize, then the price of the stock will plummet. So we want to consider the advantages as well as the disadvantages of GAP investing. So advantage number one, balance risk and reward. GAP provides a middle path between high risk growth investing and conservative value investing. Number two is downside protection. By avoiding overvalued stocks, GAP investors can reduce the risk of a significant loss if the market goes against them. They will not sustain significant loss. So your downside is kind of protected, and at the same time equally have an upside potential. Then we look at the challenges. Number one is finding the right balance. Finding the right balance is a typical challenge of GAP investing. The key challenge in GAP investing is accurately identifying stocks that offer both growth as well as reasonable valuation. They're not really easy to come by. So these requires careful analysis and a solid understanding of both growth and value metrics. The second one is market conditions. So GAP strategies may underperform in certain market conditions, such as during a strong bull market, where high growth stocks are likely to keep on growing higher regardless of the valuation. So when it comes to a bull market, this strategy may not perform very well. So who is it for? So GAP investing is suitable for investors who seek a balanced approach, combining the potential for capital appreciation, with a focus on reasonable valuation. It is ideal for those who want to invest in growth companies but don't want to pay too much for that growth, and they prefer uh, a certain level of downside protection. This strategy is good for this class of investors.